Good morning, everyone. We are moving to the week 12, company tax returns. What we're going to do first, we're going to talk about some important aspects of that companies. Then we will move into the company tax return with XPM as well. All right. So when we go to the company is a separate legal entity, like individual is a company also going to pay the tax separately. So when we talk about the individual, we have a two type of tax residents. One called Australian resident for the tax purpose, other one called non-resident for the tax purpose. We use the different tests such as reside test, domicile test, 183 days test, and superannuation test to determine you are resident or non-resident for the tax purpose for an individual. When we determine you are a resident or non-resident, that the residents or non-resident have a different tax bracket or different tax rates. You can see non-residents are not eligible for first 18,200 tax-free threshold. Also, residents going to report any income earned, not only Australian sources, international source of income as well. But however, non-resident only taxed for the Australian source of income. Now we will look into that how we are going to determine company is a resident or non-resident. Right? It is two different tests. We cannot apply whatever we previously learned as a to determine the individual resident or non-resident test to here to company. So there are different tests. We will look into that. What is the test? So company is a resident in Australia for the tax purpose if meet that one of the following conditions. Number one, it is incorporated in Australia. What's the meaning? The company is registered under the Corporation Act 2001 with the Australian Security Investment Commission, and he got that, and company got that Australian company number. So in that case, that company is incorporated in Australia. Regardless of shareholders are resident or non-resident, regardless of directors are Australian or resident or non-resident, with that company, if it is incorporated in Australia, that's going to be uh, called as a resident company. Right? Second part, if it is not, some of the companies are not incorporated in Australia, this means they're not registered as a company in Australia. However, they are operating some business in Australia. Right, the company may be some multinational foreign company, maybe do some business in Australia, such as eBay, PayPal, right, and Amazon, Netflix, right? So Uber, this all are belongs to other outside of Australian companies, but they are operating their business in Australia. So for that type of companies, the companies not incorporated in Australia, however, if they are central management and control in Australia, right? You have that your registration outside of Australia, you are doing some operation in Australia, but whole company is control, or company is control and management is from Australia, mean that can be considered as a resident company for the tax purpose. Or if that particular company's voting power is controlled by Australian resident shareholders. What's the meaning? The company is registered outside of Australia, however, do some operation or business in Australia, but the company shareholding that over 50% controlled by or held by Australian residents. In that case, that company going to be treated as an Australian resident company for the tax purpose. So what's that first one? If they're incorporated in Australia, it's going to be a resident company. You are not incorporated in Australia, but you are doing some business here. If you are central management and control in Australia, we can say you are Australian resident company. Or that you are not incorporated in Australia, but you incorporated outside of Australia. However, you're doing some business here and your shareholding that hold by Australian resident more than 50%, it's mean you have the voting power controlled by Australian resident shareholders, mean you will be a resident company for the tax purpose. So now we can clearly identify which one is the Australian resident company, which one is a Australian non-resident company. Now we are going to see what are the tax consequences if you are an Australian company. If you are a company is an Australian resident company, company should put that all they include all the income from Australian sources and other international sources into that Australian tax return. What happened? You must report all the source of income and expenses is Australia and outside of Australia. If you are a non-resident company, you only required to report Australian source of income. You no need to report outside of Australia. So that's the difference between resident company and non-resident company. So now the company is a tax entity and will pay the tax on the income. You remember that when we talk about the sole trader and partnership and trust, sole trader paying the tax by their owner, sole trader income tax paid by business owner, partnership tax paid by partners, that trust tax paid by income tax paid by beneficiaries and trustee. However, for the company's tax return paid by company itself, because company is a separate legal entity and we call companies a tax entity. It's mean company should pay their own tax obligation and lodge the tax return. However, company lodge the tax return. However, company not going to get it notice of assessment same as what you and me get it from the tax office. The company, when we individual lodge their tax return, that will be finalized and will be issued a notice of assessment. But if the company lodge the tax return, company not going to get that notice of assessment under the legislative arrangement. Only company is going to get it a account statement to settle that particular tax liability. Then company not to have a tax-free threshold. You remember we talk about that. So non-resident and residents have a difference. If it's a resident taxpayer as an individual, you will get it a tax-free threshold. This means first 18,200 you are not going to pay the tax. However, if you are a company, you are going to pay from $1 because no tax-free threshold for the that companies. So you remember when we talk about that resident and non-residents, there's a two different tax rates, two different tax brackets. We will talk about that week one. However, your resident company or non-resident company tax rate is flat, not the bracket and no different between resident and non-resident company. So what is the tax rate? The normal tax rate is 30%. However, there are lower tax rate available. The companies meet the condition as a base entity. What is the lower company tax rate? 27.5% for last year. This year, the year you're going to do the tax return, 26%. The 2022 is expected to 25%. So the lower tax rate only available to base entities. The base entity mean base that should satisfy the two conditions. What are the conditions? Number one, the business aggregated turnover should be less than 50 million, right? So every year after 18, 19, before that, this number will be 25 million. That's why I put that 18, 19, right? After 18, 19, so every year when you have calculated your aggregated turnover, if it's less than 50 million, you satisfy the one condition. But you should say get two conditions to satisfy the base entity. Second conditions, your income should not exceed more than 80% from the passive income. First, we want to understand what is the passive income, then we can go back and 80%. It's mean the passive income mean the income from the investments, especially rent, dividends, franking credits, interest income, royalties, and capital gain. If any of this income or combined income more than 80 percentage, you cannot consider that one as a base entity. So most of the banks and financial institutions, their income over 80% come from interest or in other passive income. They are not eligible to base entity, even though they are turnover less than 50 million. So the base entity is, which is the turnover less than 50 million, and your income should come from your normal trading, buying and selling the product or providing the services, not from over 80% from the passive income. Mean you are not eligible to that, get the lower company tax rates. All right. Now we will come back to the company tax loss. So when we talk about the individual tax losses can be carried forward indefinitely, and individual tax losses should be or must be offset whenever first available assessable income. It means the individual have no choice. Whenever you have the tax loss, the first available assessable income, you must offset that tax loss, right? However, company have a different rule. Company can carry forward the losses in 1 year of income deduction again the assessable income in a subsequent year, in the certain limitation is there. So what I'm saying, company also carry forward that loss, to the future. However, company can decide when they want to offset against the assessable income, but individuals cannot decide. You must offset whenever first available assessable income, but company can carry forward whenever they decide, yeah, I'm going to offset now. They can offset and pay less tax. Now the question is, you can see in the slide there are some limitation. Individuals like you and me, if you have a tax loss, no limitation. You can carry forward and offset whenever first available. But the company, uh, if they want to offset their tax losses or company losses, they should meet one of the condition. There are two criteria. If they meet one of the criteria, they can offset their tax losses. If they not meet any one of these criteria, they cannot offset the tax loss. Now we will see what is this criteria. Number one, continuity of ownership test. We call COT. What does the COT mean? That ownership should not change more than 50% the year the loss occurred to year that you offset that your losses. So if it is ownership change more than 50 percentage during the time, you are not satisfy the COT test. So you want to check that other test you are pass or not. So for an example, in your shareholding at this point $2 million in a medical practice, right? So you want some more investment for your medical practice. You asked a couple of other doctors to join with you, and they come with that 4 additional million, right? You are 2 million, you include other 4 million, it is almost 100% change in your ownership. Therefore, you are not satisfied the continuity ownership test. So therefore, we should check that other test called same business test. What does the same business test mean? Even though you not satisfy the ownership test, if you satisfy the same business test, you are able to offset your losses from that company income in the future. So what does the same in business test mean? So that when you operate when your capital loss occur, whenever your company loss, the year of the company loss, what is your business core activity, and when you offset that one in the year, that between that years is not change. That's mean you can offset. So I will give you through the example in your previous example. So you have the $2 million capital and running a medical practice. You are joined with that other $4 million worth of investors. Now your ownership change. However, your business is remain same medical practices. In that case, you are satisfying that same business test. But if, for an example, after the new investment, if you started a new business, for example, medical practices, also running with the same ABN and ACN, also you started a accounting business. So it's not same business now. You can see medical business and accounting business. Therefore, you may not satisfied if you start the different business activity under the same company. But if you remain with that same core activity of your business, you will pass that same business test, and then you are going to satisfy that capital loss offset, and you can offset from your income. So continuity test mean should not change over 50 percentage. If you not change, you don't need to do the second test. You can immediately offset whenever you decide it, because no need to that company can decide when that want to offset. And or if you not pass the continuity test, if your core business activity, accessible income where it is generated not change, in that case what's going to happen, you are passing that same business test, and you can offset your company losses, right? So that's the tax losses. Now we will come to the R&D tax incentive. Thank you. Having a water. So R&D tax incentive. Whenever you see the word R&D, we may think something scientific research or COVID research or whatever research. But this is not like that, right? R&D development tax incentive mean, so the government initiative to increase the amount of R&D being conducted in Australia. What is that? Conducted in Australia. What is that? So whenever that the businesses, eligible businesses, you all businesses have different business process, right? You should come with that some innovative business operation or business process to more productive way to operate in your business, right? So that type of innovative approaches required some research and development and testing and all this stuff. When you do that some innovative approach, it may be cost you, right? So this the innovative approach expenses will be tax offset if it's the ATO and Innovation Australia and relevant authorities if it's approved. So how are we going to do? Allow Australian companies to claim the tax offset on eligible expenditure. It is not anything scientific research or anything. It is research on that how your business process can be more productive for Australian industry. So for an example, one of my client is doing a security business. He's come with that some innovative solution for the industry. Now he's getting the R&D expenses on the that particular business, right? So that's called your R&D innovative tax offset on the on the eligible expenditure. So the basic requirement, you should have a company or corporate trust, and that must spend at least $20,000 on your R&D business process, and activities must be eligible R&D activities. This means you should put your proposal to Innovation Australia as well as tax office, and both should be approved. And that I put that your basic eligibility requirement. If you click that, it will give you all the R&D process. All right. Then if it is approved, that you you will qualify for offset. So how much that offset? So there are two type of businesses here. One called smaller companies, which is less than 20 million turnover. They will get it 43.5 percentage of their R&D expenditure as a tax offset. So if you are a large company, 38.5 percentage, but you can see non-refundable tax offset. So large company is going to get non-refundable tax offset. So what is the difference between refundable and non-refundable offset? The refundable offset mean you will get the refund back from ATO after satisfy that your tax liability. But non-refundable mean your tax offset will be restricted up to your tax liability. For an example, your company have a $50,000 tax liability, and you are a small company, you have tax offset 60,000. Can you write down in your textbook? 50,000 your company tax liability, but your R&D tax offset $60,000. So in that case, if you are a small company, what you can do, you will get it a $10,000 refund back because you have a refundable tax offset. If you are a larger company, maximum you can get it up to the $50,000 offset all your tax liability. You cannot get that balance 10,000 because that's a non-refundable tax offset. So your refundable or non-refundable determine based on the your tax offset will be, yeah, or maximum you can offset up to the tax liability. For non-refundable offset, you will not get it the refund, but the refundable offset mean you offset your tax liability. If it's any balance, you can get it back as a refund. The non-refundable offset, whatever the 10,000 is forgone, right? For larger companies, if they can't if they offset, balance will be forgone. I will give you example what is that innovative industry. Some example here for R&D. So comprise in the total income $150,000, R&D expenses $90,000, and other expenses for that business. How much? R&D 100,000. Apology, and other expenses 90,000. So calculate the tax payable. So first you want to calculate how much your accounting profit or loss. So how much accounting profit or loss? See, a loss 150 minus your expense 100 plus 90K for $40,000, you are accounting net loss. So then to calculate the R&D offset, your step one, you want to add back your R&D expenditure subject to offset, which is $100,000. So how much your taxable income now? 60,000. Right, for this 60,000, assume that 1920 with that base entity 27%, 16,500. Now assume that this is a small business entity or small company. In that case, 43.5%, they will get that offset for the 100,000 they spend on R&D. So 43,500 is a tax offset, R&D tax offset. How much tax we required to pay? 16,500. So what if for a small company, they will get it $27,000 back. If it's a large company, they will not get anything refund back because the R&D offset will be 38.5%, which is 38,500. Only you can offset all the 16,500 for larger companies. For the small company, still 43,500 is good. The balance 27,000 will be refunded to that small company's tax refund in the bank account. That's called research and development incentives. When you go to that in our tax return, I will show you there are separate R&D worksheet. You can include these amounts. It will give you that refund. Right. Now we will go to that company bad debts. So when we deduct that bad debts, give me a second, I have a water. When we deduct the bad debts from our income tax return as a deductions, the bad debt must be bad or actually bad. So what is the meaning? When we do the financial report, we are written off in our bad debt based on that our accounting standards and companies accounting policies. However, you cannot do that with that your income tax return, because that's income tax return bad debt is a different legislative arrangement if you want to deduct. That means, so that what is the tax legislation ask? If you want to deduct the bad debt, you must prove that there's no any chance to that recover that amount from your customer. So you should prove that client is insolvent, client is a bankrupt, or clients, we take the legal action, is not successful, or we take debt collecting agencies, it is really that anything not turn out as a collectible, or you small amount, you did that all the different business process to collect, unfortunately not collectible if a small amount like $100 or $50. So if you take all the steps, if you can't collect, that's not recoverable, you can deduct from your income tax as a deductions, otherwise you cannot. So whenever you deduct the bad debt, you remember that will be a separate label in our tax return. Tax office can anytime ask you, can you prove that, what is the step you take, how you decided, this will be not recoverable, right? You must prove, as I said, one of the reason as mentioned previously. So individual bad debts, if you meet that previous criteria, what I told, you can offset it. However, for company bad debt, if you want to offset, you must meet, you must prove this is a bankrupt or is insolvent, or you take the legal action and fail, or you went to the debt collecting agency, you couldn't collect it, or similar amount, you try over your emails and phones and all the correspondence, you couldn't make it that recoverable. That's fine for individual, but the company, in addition to that, and you must satisfy one of the tests. What are the two tests we learned previously? Your continuity test or same business test. I don't want to explain because I explained previously what is the continuity test. It's mean your ownership not change more than 50%. Same business test, your core business activity not change between bad debt occurred and bad debt recoverable. That's deduct when you deduct, right? That's called bad debts. Capital gain, you remember we talk about the capital gain. Individuals will be eligible to get the 50% off. We have two methods we use that for calculate the net capital gain, right? Capital gain equal to capital proceeds minus capital cost base. So that capital gain can be reduced using the discount method or that frozen indexation method. So discount method 50% off. However, discount method only available to individual Australian residents. So individual Australian residents, and that's a 50%, and super funds 30%. So companies are not eligible to discount. So you will not get it 50% off when you calculate your net capital gain for the companies. But you can use that Rosen indexation method if you think that's reduced at your capital gain, right? So the discount method is not available for companies. Capital loss, same as tax loss. The capital loss we can offset against the same group of capital gain in the future for individuals, right? Same rule here. However, if you want to offset the capital loss in the future, you must meet one of the criteria. Continuity ownership, this means not change 50% of the ownership, or same business test. If you meet one of the criteria only, you can offset your capital loss down the track. Now, company taxable income. Some of you guys emailed to me and asked that, can you explain why is the reconciliation in the tax return? You can see in your partnership, there's a reconciliation section under the business. Sole trader, there's a reconciliation section. Trust, there's a reconciliation section. And company tax returns also a separate page for the reconciliations. The reconciliation mean, so we going to be adjusting our financial report to comply with the tax rules. That's the way I can say. Because in our net profit, taxable income does not always equal to net profit. Taxable income always not equal to net profit. Why it is? Because your net profit, your financial profit and loss prepared based on your accounting standards, your Australian accounting standards, right? So how we are going to prepare net profit based on your Australian accounting standards. How is the taxable income calculated based on the income tax legislation and case law and some guidelines from tax office. So totally two different rules to calculate the net profit and taxable income. Therefore, net in your profit and loss statement, net profit is not going to be equate to your taxable income. That's simple. However, if you are input in your all the net profit into that your tax return, you want to adjust that whatever adjustment required to make it as a taxable income, that profit. For an example, so you get it from the date your cash flow boost, $50,000 for your client. That will be your assessable income and increase your net profit by 50,000. Sorry, your profit will be this much. However, when we calculate the taxable income, that 50,000 we are not going to include because that's not assessable. So 50,000 different between net profit and taxable income. So how are we going to adjust? From the net profit, you are going to reduce 50,000 as a cash flow boost. That's called reconciliation, right? Because the net profit source 50,000 more than taxable income. So if you want to reconcile between net profit and taxable income, what you're going to do, you are going to reduce 50,000 from the net profit. In other way around, for an example, your client running a restaurant, they got a fine for that some operation in the business, $20,000. So your $20,000 profit, that expenses reduce your net profit by 20,000, right? So however, when we calculate the taxable income, that fine and penalties not going to be considered as a deduction, but your net profit now showing less. So if you want to minimize your taxable income, what we should do, we should add back with that net profit, that $20,000 fine, to make it taxable income, right? This is called reconciliation in the tax return. If you enter all of your financial report information in your tax return, then you want to see every single section, and to anything not deductible or anything not accessible, you want to adjust. One of the other good example, depreciation. We are calculating depreciation based on the accounting standards, but we deducting that in our depreciation for the capital in the taxable income based on the tax law. It's a good example is immediate write-off. For an example, you purchase a asset on 30th of June 2021. So, sorry, 30th of June 2020 for $100,000 equipments. In your accounting statement, in your balance sheet, 100,000 going to be treated as a balance sheet item, no depreciation. But when you go to the taxable income, you can use whole 100,000 as a total immediate write-off under the depreciation section. So that's not going to be net profit going to be that higher. If you want to reduce, you want to reduce from your net profit by 100,000 in the tax return, not the financial reports. That's called reconciliation. I put that some example here. You can see fine and income tax expenses and provisions are not included as an expense in the tax return. Not included as a deduction in the tax return, but it's in the profit and loss, that may be expense. Some amounts may not have been included as a revenue, like a cash flow boost, franking credit and net capital gain should be, franking credit and net capital gain, it may be not included in the revenue in the profit and loss statement, we may be include. In other way around, you include cash flow boost as a income, so we want to remove that one. That's also we can. Some amounts can be claimed as a deduction, not included in the expenses. What are they? Prior year tax losses, normally not in your financial P&L, profit and loss statement, but you can do that through the taxable income. So all this example, why we are doing. So the last one is the cash boost. The cash boost from the tax office exempted. However, in your financial report, that's as an income. So we want to do a reconciliation. So I put that something what I discussed a couple of seconds before. You're adding your net capital gain and franking credit. You're adding your accounting depreciation. You are adding any not allowed items in that financial report. For an example, doubtful debts, unpaid superannuation, non-allowable donations, capital expenditure, income tax expenditure, increased provisions, all things you are going to add back with the your profit, because these are the item which going to be reconciled. Second part, you can take it out as a deductions for that exempt income, because exempt cash boost should be taken out from that net profit, and less declining value of that any tax purposes. You remember immediate write-off can be taken out, and any specific deductions you can take it out, like a tax losses and etc. Right. So this is the way we're going to do the reconciliation. So reconciliation means you are marrying with the net profit and taxable income. Right. Now we will move into franking credit. What's the franking credit? I will explain through a little example. That's easy. All right. We'll go to in our tax returns. Here it is. Assume that your client Steve Smith running a business and his taxable income $300,000. He put it in the tax PM and he got that 118,597 as a his tax component. He come to the accountant and say, hey, I'm paying almost 1/3 of my income, no more than 1/3 of income as a tax. Can I go with it some different way? Yeah, we can go with the company and pay the less tax, right? If you go with the company, if you assume you are a under 10 million turnover, sorry, you are satisfied that base entity category under 50 million, under 50 million, and let's not less, only doing the business activity, not the passive income, you may be a lower tax rate, which is 27.5%. You will be only going to pay $82,500. Now we will go back and share with you a Excel sheet, and we will work a little bit more. All right. First one, everybody can see that Excel. I'm assume that. I will make sure that you are in the Excel sheet. Yeah. So if the sole trader business, what's going to happen? So that's taxable income tax rate will be in our tax bracket, like 18,200 and 32,500 and etc. Anyhow, you use that your XPM and say your tax will be 118,597. That's one we saw that couple of seconds ago. So then you just put that your how much money will come to your bank account, 300,000 your taxable income. You paid all of that your taxes, balance will be this much. If you go as a company, your taxable income this much, and 27.5% tax rate, which is 82,500 tax, which is balance 217,500. Now question is, can I spend all of this money as a sole trader? I have my taxable income this much and my tax is this much, balance in my bank account 181,000. For this 181,000, you can do anything. You can buy a furniture, you can buy the TV, you can buy the house, you can buy the land, you can buy anything you spend on the Woolworth or Coles, or even you can go to Dan Murphy and spend it. Anybody not ask. Tax office not going to ask, because that is your disposable income after the tax come as a individual. Now, if you set up a company, can you spend all the stuff what we discussed previously, this 217,500 balance? You cannot, because that money belongs to company, not belongs to you. You cannot spend it to that Woolworth or Coles or Dan Murphy. You want to that based on the tax law, you want to get this money back to your bank account from company bank account. From company business account, you cannot spend whatever you want, your personal furnitures and any other items. Now, how we going to get this one? We normally get it as a dividend, right? So we assume that you are the only one shareholder. So all the money give back to you. So how much you get it as a dividend? 217,500. You remember, when you get the dividend, individual should pay the tax on that. Oh, are we going to pay again to the tax this one? You will be not happy with that, right? Because you already paid the tax 82,500. Again for the dividend, if you are paying, you will not happy. However, if you when you are paying to the tax, the amount of the tax paid by company, this 82,500, can be considered as a that your franking credit, right? Because when you're paying to the tax for this amount, already this tax is paid, right? So that amount going to be we consider as a franking credit. So when you calculate your taxable income for individual, you are calculating based on your bracket. Then this 82,500 will be taken out from your tax liability as a franking credit. Assume that you have the 10 shareholders, you equally distribute to all 10. So how much you got it? You give it to everyone 21,750, 21,750. So how much that each shareholder's franking credit? 8,250, because 10 I gave the 10 the shares divide by 10 mean your franking credit also divide by 10. So the bigger companies, when they seeing thousands of shares, whatever tax amount, the dividends, so whatever that dividends paid to that shareholders, that proportionally that franking credit available for that particular shares. That's called franking credit coupled with your tax, that your distribution, right? So when we calculate the franking credit, we're going to use some different calculation method. I will come back. We are not going to add 217. We add back to the 300 and reduce the 82,500. I will show you through the example in our slides. All right. I will go back to that your slides. Everybody can see that now, franking credit. So whenever company issuing the franking credit, so you require to have a franking credit account. So what is the franking credit account? Whenever you paying to the tax to ATO, that will be credited. Whenever you are paying to that 82,500 to ATO, your tax amount will be 82,500 credited in your company franking credit account, right? So in your accounting treatment. Whenever you issue the distribution, it will go out from that as a credit, right? So for an example, 82,500, so we show that as a tax, right? So what assume that you are only half only you distributed to that your shareholders. In that case, 42,250 will be debited. You only give it that 1/10 of your total retained earning to that your shareholders. Rest of the money you required some company purpose. In that case, 1/10 of tax what you paid will be debited in your franking credit account, which is 8,250. So you want to manage that uh, your you want to manage that your franking credit account and report through the tax return every year, right? That's called franking credit account. So it will be roll over every year, and because you may have some retained earning. Franking percentage, you may heard about that sometime we call partially franked dividends, right? So something full frank dividend, which is we talked a couple of minutes before, other one called partially franked dividend. So we want to understand what is a partially franked dividend or franking percentage. Both will be same tax consequences, right? I will explain through example. Assume that, so you have a company, is a total amount distributed to you $11,667, right? Assume that you are a one shareholder, company is a 30% tax paying, and you have a previous year tax loss 6,667. Okay, assumption, right? To understand what is that percentage. So when you are doing the tax return, you will remember when we are week 3 or something, when we talk about the franking credit, we said that Whatever net amount you received, you're going to recalculate your net income and report to ATO. So how much that current year net income? So you receive your net distribution 11667 mean. So how much going to be that your actual income? 70%, because 30% tax paid, balance only 11667. So how much the 70%, which is 16667. That's the total income. So now you calculate how much your franking credit. 30%, we use the word maximum franking credit, you will get it $5,000, because you reverse engineering. But you did that, you go back and say how much that income. So 16667 you're going to include as a assessable income dividend, and 5,000 going to be your franking credit that will be taken out, right? So that's the same as in your PAYG, how we doing net wages plus PAYG, your cross wages. Net dividend, what you are received in your bank account, plus tax component 5,000, which is going to be 16,667 in your current year assessable income. That's very simple. However, in this case, you can see that your company did not pay all $5,000 because they had some previous year loss assumption 6,607. I make it for 10,000 for you to understand easily. So how much the previous tax offset? 667. So how much the actual tax company paid? Only $3,000. They gave to you 11,667. However, actually company did not pay $5,000 because of the tax loss. They only paid $3,000. So when you do the tax return, how much we can claim? 5,000 or 3,000? We can maximum claim really only $3,000, because company only paid for your tax or for your dividend only 3,000 because of the previous year tax losses. Therefore, when you are claiming the tax, the franking credit, you cannot claim all 5,000. You only claim 3,000. So portion of the 5,000, which is a 60% of the your franking credit, which is 3,000, you can claim, right? This is called partially franking credit. Whenever the dividend statements say 70% franking credit, you can understand some tax loss or some other reason, that's a tax that company did not pay full tax on the dividends. If they paid full tax on the dividend, 100% franking dividend. If they're not paying, if they have the tax loss or any other circumstances, so in this case, you can see maximum franking credit 5,000, but actually company paid 3,000. So I'm going to say 60%. Right. So now we will move into the company tax return. So I'm sure that you guys are clear. The 60% will be normally come up with that your dividend statement, 60% or 70% or 20% or 50%, which whatever that way the company paid the tax, the proportion of that maximum franking credit will be so in your distribution statement, right? As a franking credit percentage. Then we will move into the company tax returns as normal. I put it all the label. When you have the time, you can go and click and see how it's going to be every label, what's going to be involved with that one. Then you can go and enter. So now I am going to share with that you are zero practice manager. Right, so you all know that how to create the tech company client. So you can go to the new client, and so everybody can see that. Yeah, excellent. So you can select the company, right? So company, the first one, put the XY Limited. We'll put it something because that's maybe some other XY Limited already there. You put all of the information what is required for that company and include that one. Rest of the information you just fill it out same as previous. And now you are going to create the tax return. So company tax return called CTR. So company tax return was CTR, company tax return 2020. You click that 2020 tax return. Now it'll come up. Yes, that's our tax return. I put it some income first to So we'll go back here. So there's no any different, but however, this is section 6. Previously, we used partnership for 5, individual for 5, or sole trader for 5. Here you can see there are little different. These things are all same, but normally we put that business income and other income in other business tax return. But here one column called other sales, goods and services. You can put it all your different type of income, from that under this section, your business income. So if the company can be a partner with that other partnership, that partnership distribution will come up here as a income. Company can be a trust, as a beneficiary for the other trust. That trust income will come up here. I'll put it, for example, $30,000, which is, you want to say which kind of company, which kind of trust, that one, said how to do that. I'll put it here around 270,000 as we discussed previously. So we have around 300,000 income. So all the other things are same: interest, cross interest from the bank, and the dividends in the company. If they have some shares in that other company, it will come up here. And if you have a job keeper payment, you can include under the government industry payments. That's a job keeper. So all this one, if it is anything miscellaneous, you can put under other income. Expense column, I don't need to explain again and again. We did that the same format here. Only the different, you want to, I did not discuss previously, not difference, I did not previously discuss. You can see in these expenses, you cannot see what are the wages and salaries. One of the key or biggest expenditure, most of the financial report, but they did not ask you to separately. So the where you going to include, you're going to include under the cost of sales. You can put cost of labor or wages, that's amount here, under the cost of sales. Or you can go to other expenses in the bottom and write down where the wages and salaries this much. So you're putting other over there, but when you go to that your um, financial information, salaries and wages, you must say where you put it, under the all other expenses or under the cost of sales. Sometimes we put it the both places, right? Cost of good, under the cost of sales, we could put the direct labor. Under the other expenses, we put the indirect labor. For an example, if you're running a factory, all the factory workers will fall under cost of sales, but all the admin officers in that factory, it will fall under other wages. That's the reason you can see cost of sales and other expenses like that, right? So you want to make it clear where you are including that wages and salary. Now I will come back to here. How much the tax they want to pay here? $90,000. So in the cover page is very straightforward, everything, but this is the area is then new to you. Residency, that resident or non-resident, you can work it out and put it in. And type of company, that we can get it from the company register. Anyhow, most of the company you are going to private company. Is there anything other limited partnership or whatever you do, you can put it here. Status of the business, there are 3 types. The cease business mean business is going to be closed, and commence business mean already commenced the operation. And if you have multiple business operation in currently, you are going to put multiple businesses, right? So in the same, under the one company, if you have multiple different businesses and branches, you're going to put E1. Next one, small business entity. If your business is less than $10 million turnover, you can put JS, which is tax assessor to C, to that you are that other small business entity concessions, right? You must say yes or no. This is the one very important. Most of the tax agents and tax consultants sometimes forget to click this one, right? If your business is less than 50 million and not earning more than the passive income more than 80%, you can say, yes, I am the business entity. You can see you can reduce to your client $7,500, right? That's called base entity. So you must say yes or no. If you just allow that just like this, tax office is not going to come back. Tax office is going to send $90,000 bill to the your client. He is going to pay, right? Because this is not the compulsory item to make sure that you are linked here. So this you must click yes or no, right? That's a very important. So when we go back to the rest of the stuff, very straightforward. Public officer, who is a public officer, you can see from the company records and enter the person who from the business who is going to be a public officer for that particular company. And then you're going to put your name as a contact name and then how many hours you took that, prepare the tax return. So now you can come back to the reconciliation interesting part. You remember I said that you are going to marry with that your net profit with your taxable income. So whatever item I said that you want to add it, you want to put that in a adding section. Whatever that less, you're going to put as a less sections. Then it will be balanced. Financial statement. This is based on your financial report balance sheet, and you are going to include all the your balance sheet items here. When it is finished, assets and liabilities. This is straight away from financial reports, right? You can see one of the stuff. Your franking account balance. You're going to say that how much the balance in your frank account, and you show how much the dividends, how much unfranked dividends. Then other information about the capital allowances, whatever your depreciation details will be here, and you can do your small business entity depreciation from item 10 right in your lower. So that's the one is in the 10. This is the calculation sheet. If you want to do a R&D expenses, you can go to that new schedule and click a research and development, and you can work it out that all the information, accounting, profit, and everything what we discuss. When you enter, it will be automatically calculate that your R&D offset, right, based on that you are a large business or smaller business entity. So that's it with that company tax returns, and we will go back to that our slides again. So all that labels, whatever you want to include, I put it very clearly here for you to that understand where you are going to enter the information. And you enter, there will be homework available. There are 2 homework this week. So you can finish it off. And that's now we'll come to that almost final part of that our workshop. No more recording or no more workshops available from this week. So it's mean you are going to do your own all of your work. Please more focus on homework 10 and 11 and 12, and ask that any clarification required from that your tutors, and whenever that you completed that process, and most probably we decide to put your assignment on um, most probably 5th of uh, so we plan to put the 30th of June this week. Most probably I may be moving to that one week more. I will discuss with the other lecturers and decide. Most probably 6th of June it will be available to you. So whenever assignment available, after that you have no access to that your tutors. You're only going to do yourself. Whatever right or wrong, you're going to do that everything with that one, right? And all the instruction will be provided through that email. So I just want to give you some one more week for you to that look into that all the assignment before providing the assignment. Whenever assignment available to you, tutors are not available to answer any of the questions about your homework or assignment. So please make sure that you cleared everything before 6th of May 2021. It's been 2 weeks from now to that all of your homework, and any clarification required, you can ask from the tutors. Thank you for your time. So we really enjoyed the workshop and looking forward to see you in the PTP or anywhere in the accounting practices. Thank you. Bye.